Imagine you own a bond paying 5% interest. Then one day, the Federal Reserve raises rates to 6%. Suddenly, your bond is worth less. But why? Why would a bond lose value just because interest rates went up? This inverse relationship between bond prices and yields is one of the most important concepts in all of finance. Let's break it down from first principles. A bond is simply a loan. When you buy a bond, you're lending money to a government or corporation. In return, the borrower promises to pay you regular interest payments, called coupons, and return your principal at maturity. For example, a $1,000 bond with a 5% coupon rate pays you $50 every year for the life of the bond. At the end, you get your $1,000 back. These are the cash flows that make a bond valuable. So how do we figure out what a bond is actually worth? The price of a bond equals the present value of all its future cash flows. Each coupon payment and the final face value are discounted back to today using the market interest rate. Here's the key formula. Each future payment is divided by 1 plus the yield, raised to the power of the number of periods. When the yield goes up, each denominator gets larger, making each present value smaller. And that means the bond price falls. Let's see this inverse relationship in action. Think of a seesaw. On one side sits the bond price. On the other, the yield. When yields go up, prices go down. When yields fall, prices rise. They always move in opposite directions. Why does this happen? It's simple competition. If new bonds pay 6%, nobody wants your old bond paying only 5% unless its price drops enough to make the effective yield competitive. The market automatically adjusts. Watch how dramatically bond prices change as yields move. An year bond with a 5% coupon is worth $1,000 when yields are at 5%. But if yields jump to 7%, that same bond drops to about $860. A 14% loss just from a 2% rate increase. Notice the shape of this curve. It's not a straight line, it's convex. This means bond prices fall less when rates rise than they gain when rates fall by the same amount. Investors call this property convexity, and it actually works in your favor. Duration measures how sensitive a bond's price is to changes in interest rates. Think of it as the bond's interest rate risk. A bond with a duration of 7 years will lose approximately 7% of its value for every 1% increase in yields. Longer maturity bonds have higher duration, making them more sensitive to rate changes. A 2-year treasury barely moves when rates change, but a 30-year treasury swings wildly. This is why long bonds are considered riskier. The yield curve plots interest rates across different maturities. Normally, it slopes upward. Longer-term bonds pay higher rates because investors demand more compensation for locking up their money longer. But sometimes, the yield curve inverts. Short-term rates exceed long-term rates. This is a powerful recession signal. An inverted yield curve has preceded every U.S. recession in the last 50 years. It means the market expects the Fed to cut rates in the future because the economy is weakening. Not all bonds are created equal. Treasury bonds are backed by the U.S. government, the safest borrower. Corporate bonds pay higher yields but carry credit risk. And municipal bonds offer tax-free income, making them attractive for high-income investors. The yield spread between corporate bonds and treasuries tells you how much extra compensation investors demand for taking on credit risk. When spreads widen, it signals growing fear in the market. When they narrow, confidence is returning. Here are the key takeaways. First, bond prices and yields always move in opposite directions. This is the fundamental law of bond investing. Second, duration tells you how much interest rate risk you're taking. Third, the yield curve shape reveals the market's expectations about the economy. Understanding bonds is essential for any investor. They're the backbone of every portfolio, the benchmark for pricing risk, and a window into what the market thinks about the future. Now you know exactly why prices fall when rates rise, and how to use that knowledge.